I'm Shihao Feng for PERE Credit. We're here at PERE America Forum. So today I'm joined by Paul Rahimian, founder and chief executive officer at Parkview Financial. Paul, good morning.
Good morning. Thank you for having me.
Thank you for taking the time with us. Paul, I know that Parkview Financial has been actively lending to the middle market. So I guess my first question would be what are some of the highlights in your lending activities in the past year to the middle market, and where do you see the biggest opportunities in that space of the market?
At Parkview, we do focus on the middle markets, which we define loan sizes between 25 to 75 million. Historically, over our fund cycle, we have done loans smaller and bigger between 5 to 200 million. But what we've learned through the past cycle is really there's an inefficiency in the marketplace in that 25 to 75 million range. A lot of lenders do loans 20 million and below. A lot of the bigger institutional players do 100 million and above. It's really lacking in that 25 to $75 million space. And that's why we find that we can be mostly competitive and really provide a great service in that segment.
Yeah, right. So you talk about this credit cycle. I'm also curious about the new loan originations at Parkview Financial. So how are you seeing this maturity wall in the commercial lending space is getting resolved, and how are lenders addressing these issues with their loan originations?
Sure. So there is an impending maturity wall, and I feel like we talk about it every year and it gets pushed out a little bit more as lenders are providing extensions or trying to resolve issues. I think we're at an inflection point that we're probably going to see more of a resolution of this maturity wall over the next few years. There's three, I think, factors here coming together, converging at the same time. First of all, you have a lot of these loans that were made in the past cycle that are really getting to the point where they're maturing. You have a lot of funds that are ending their life cycle. They were originated in 2016, 17, 18. They had a 7 to 10 year life cycle. They're getting to the point where they need to exit assets, which means they are naturally sellers for the right reasons. Then you also have some equity funds that raised money in the past 3-4 years, and they're getting to the end of their investment cycle. They had a 4 to 5 year investment cycle. They're naturally buyers. So I think between those two, and then the third piece is the lowering of interest rates, which we've all seen over the past, I would say, year and a few months. I think when you bring all that together, you're going to see that in the next year or two, you're going to see transaction volume increase. We've seen a little bit of an increase this year, but more of an increase as people are forced to sell assets, people are forced to buy assets because they're getting to the end of their investment thesis. And so when you get those together, I think you'll see that maturity wall that everybody's concerned about really dissipate over the next few years.
Yeah, right. I think, as you said, factors like refinancing and acquisitions will really be the main drivers for the next cycle of loan origination. So I guess my last question will be around just your outlook for your lending activities in the fourth quarter and the incoming year. How do you see the private lenders continue to take the market share in the future market, basically, with a potentially lower interest rates environment and also a more liquid capital markets overall?
Yeah, it's a great question. So we do feel like capital markets are starting to thaw. You're seeing more liquidity in the marketplace. Banks are still not full force into the marketplace. They will lend in different capacities. They like to lend as a CLO to other lenders or do other types of activities, not really focused on ground up construction financing or bridge financing like we do at Parkview. So I think there's an opportunity there for private lenders to continue to take bigger market share. We're really focused on the fact that multifamily is really a supply-demand dynamic. There's been a lack of supply in multifamily, started in 2008, has not been resolved. There's anywhere between 4 to 6 million housing unit shortage in the US. And now we're in a new cycle where multifamily starts are lower They've been lower for the past year or two. So you fast forward 2 or 3 years, and you're really going to see that multifamily is going to, again, be another strong asset class. So for us, the focus is anything that you're originating in today's cycle, call it a 2025, 2026 vintage, would be very strong, both from an equity side and a debt side.
Yeah, awesome. Thank you so much for sharing your insights with us.
Of course.
Thank you.